My name is Ray Kraus. I'm a principal at Sikich. Also join me today, a little bit later on in the presentation, will be Heather Boniface, who's a senior manager at Sikich. So welcome. This is the last session of our higher education webinar. Hopefully you've learned a lot the last few days, and we'll finish up in this next section on board governance. Excited to talk about this topic. We're going to talk about board responsibilities, discussion, the composite score, two things that I think the board sometimes has questions on, so we want to make sure we cover those. On the composite score for higher education institutions, something that I get a lot of questions from board, trying to understand it, and also really understanding the Form 990 and what purpose it serves for the institution. So Heather's going to cover that section as at the end. As far as a little bit of background about board governance and my role at Sikich, I work on a not-for-profit higher education role. That's my whole career at Sikich has been in that role in the higher education field. So that's really my area I focus on. And as far as board governance, I've been on boards, not-for-profit boards, my entire career at Sikich. Probably the last 20, 25, 26 years, I've been on at least one board. Many times I've been on multiple boards. I currently serve on one board as well. But I think that's really a key, is something I've been passionate about my whole career at Sikich is giving back in the community and be able to be on boards. And I've learned a lot through serving on different boards, some smaller boards with maybe 5 or 6 members, up to some larger boards I've served on with upwards of 20, 25 members. So really, the responsibilities of the board really could be broken down into 3 main categories. Now, there's going to be appears to be some overlap when you get into some of these categories, but it really comes down to 3 categories. Really, strategic. The second one would be legal, and then fiduciary would be the third category. And we're going to talk in depth about each of these categories. So strategic responsibilities, really, what does the institution have? The mission is really the important thing for institutions. So does the institution have a mission statement? Of course, most institutions would, but really the important thing is how often is it reviewed to be sure you're accomplishing that mission. It's very important that the institution stays on its mission, because things change at universities. You know, we've seen schools become accredited where they're able to offer postgraduate degrees, so that changes sometimes your mission, who you're reaching as students. I know a lot of times schools have reached out to have more of a foreign presence, more foreign students applying for institutions, more grad school applications. Obviously, we learned a lot in the last 5 years with online school and online institutions be able to offer programs online. So your mission does potentially change over a course of time based on how the school changes. And these mission statements don't have to be overly complex. I use an example here for Harvard. You know, a school like Harvard has been around the longest, actually, the oldest school in the United States. Their mission is, as America's oldest, most venerable institution of higher learning, Harvard's mission is to advance new ideas and promote enduring knowledge. So it's not overly complicated. That advance new ideas, I think most institutions would want to be able to claim that as well, and obviously promote that knowledge. Of course, the strategic plan is really what the institution does to achieve its mission. It's very important also to have that strategic plan, because that plan really needs to involve measuring outcomes and performance against those budget and goals. It's very important that that strategic plan is followed, and it's, once again, that's something that's updated regularly to be able to understand if you're fulfilling your mission and how are you measuring that fulfillment of that mission. Other key strategic responsibilities of the board would be hiring key positions within the organization. It's very important that you have the right people in place, right? That could be the college president, the provost, people in finance, financial aid, all the different departments, the registrar, all those key areas within an institution. It's always important. And the board has a responsibility in some of those key areas to evaluate the performance of those individuals as well. If they're not receiving regular performance evaluations, really it's doing a disservice both to the institution, it's doing a disservice to the individuals involved, and of course, potentially the board as it relates to it as well. Board self-evaluation. This is the tough one. This is where a board has to take an exam and look at itself to see if it's performing at the desired level that they believe all members need to be contributing to the institution. That self-evaluation. I've been on a lot of boards, and a lot of times it's looking in the mirror and saying, "Am I doing everything I could be doing to better serve the institution or the organization that I'm representing?" And I think that's very key. And it's not just, the second point is, contributions to the board aren't just monetary. I know a lot of that's implied when you sign up for boards. There is usually an implication that you're going to contribute in some way. Obviously, financially, that's important. Institutions to be able to continue to grow and be able to promote that knowledge and attract students. There is a financial obligation as well, but the board should be engaged. It's not just the monetary areas that boards need to be engaged. It's all the other things that have to happen in order for a board to be successful. I know a lot of times boards have long-standing board members that maybe have been their alumni. They've been there for 30 years, they've been on the board, and maybe they're just not as engaged as they used to be. And that's a very difficult conversation to have with a board member, to maybe ask them to move on or things like that. But having that emeritus status is something that potentially satisfies both needs, right? It gives that individual still that status that they're still engaged as a board member, but they may not be a voting member at that point. So, that self-selection sometimes doesn't always work, but it does at some point. Sometimes I've been on boards where after that self-evaluation is over, we've had board members resign because they just don't feel that they're contributing enough, or they've really spent enough time to be able to be good board members for that in that cases. Another responsibility is recruiting a diverse board of directors, and I think that's important too, because board composition, is important. You want to obviously have people that are passionate about the institution. So, whenever time I look at a board of directors list in one of my audits, I see all these different numbers after their names. It's the year they graduated, right? So they want to have their alumni. They're going to be the best, most passionate members if they're the ones that walked on stage and got a degree from that institution. So they're going to be some of your better board members, but you still need to have a diverse set. You want to have diverse ideas. You don't want to have, if I look at the listing, it's all board members that graduated in the 1980s or 70s. Maybe that's not a real good diverse board. We want some newer ideas, maybe some more recent graduates that have a more diverse board, that have more diverse ideas. And that diversity is in a number of different ways, of course, to achieve that diversity. I think it's very important because it promotes new ideas. And you don't have the same way of thinking as that institution. The other key role too is really assigning those members to committees. In most boards, you're going to have separate subcommittees, whether it's an audit committee, a investment committee, a fundraising committee, all those different committees. You try to find people and assign talent according to where they're best suited for, right? And it's, unfortunately, as a board member, I mentioned I've been a board member. I've been typecast quite a bit as an accountant, of course. So usually I find myself on a financial or the audit committee, and I understand that that's obviously where my experience lies. So that makes the most sense for someone like me. But when you're looking at board members, you're trying to find where they'll best fit and where they'll contribute the most. And I think that's very important. And that's one of the other strategic responsibilities of boards. Next category we can get into is legal responsibility. So really in legal responsibilities, there's a few items there to talk about. One is duty of care. Really, it's conducting the affairs of the institution where a prudent person would act, making sound decisions at board meetings. That's important, obviously, because that affects sometimes the reputation of the institution, which is very important. We're going to talk about that in another slide. The next is duty of loyalty, and that really, when you drill down into really, is there a conflict of interest policy? And is there any members that's really acting out of personal gain? And that's something that obviously institutions want to try to stay away from. There could be conflicts, and that does happen. You do have board members that maybe contribute a different way. For example, if you had an attorney on your board and that attorney is doing pro bono work, that's a good thing. Obviously, that conflict needs to be disclosed and discussed. But in that particular case, it is benefiting the institution. So it wouldn't be something you'd want to automatically write off and say, well, that board member can't serve on the board if he's representing certain things. Maybe in some cases where that individual is paid, and maybe there's cases where they would have, excused themselves from any votes and things like that. But that duty of loyalty has to be part of the discussion. And that, where it gets, noted is when you have that annual conflict of interest policy. So another very important thing too is to make sure that that's being followed, and you're actually having that conflict of interest policy obtained every year. And it's, if there are conflicts, that those conflicts are discussed at that board level. And finally, duty of obedience. Board members should be faithful, obviously, to the mission of the institution and never make decisions that would compromise the mission. And that's very important. Reputational risk is out there. You see in the news sometimes where schools have done, some controversial things, and maybe the president or something had made a statement that was insensitive to different people, and those things make news, and you're trying to obviously keep out of the news for those reasons. So that duty of obedience is very important, that the board takes that responsibility. There's also, other responsibilities too, because there's legal responsibilities, as I mentioned. You have to comply. You're receiving a lot of federal and maybe state aid. There are various compliance requirements that the institution has to meet to continue to receive, for example, financial aid. The other thing that has to be obviously met is to make sure you're accredited, right? There's a lot of accrediting agencies that do a really deep dive at that institution and make sure that they're following all the rules that are set place for institutions to be accredited. So the mission of the board, obviously for the legal responsibility, is to make sure that they're adhering to all those various compliance requirements, whether it's a federal compliance requirement or state, or as I mentioned, there's some, for example, the Higher Learning Commission, HLC, we see quite a bit in our institutions. That's a major third-party accrediting agency that does a very thorough, when they come out to do their reviews, luckily they're only every so many years, but they're very thorough, and they're looking for, things, not just financial things, but other things as well. So that duty of obedience is very important in those cases. So fiduciary responsibilities, that's that third category we were talking about earlier. Quite a few here in this category, but really the board members have to act in the best interest of the institution. That's very evident because what gets put out in the press, or what's reputational risk, is students are deciding where they're going to go to school, and if they see issues with that school in certain circumstances, that obviously could affect their future and their decision to attend your institution or not. So the board definitely always has to act in what is in the best interest of the institution. Sometimes they have to make some unpopular decisions. For example, closing one of a satellite campus. It may affect a certain number of students, and it has a negative effect for that very few students, but maybe that satellite campus is just not effectively benefiting the institution. Maybe the enrollment's so low, or the cost is so expensive that it's going to require additional funds to be borrowed or spent to maintain that satellite campus. Well, those the best interest of the institution may have to be to close that satellite campus. And like I said, sometimes it has a negative effect on certain students, but overall, you have to look at what really benefits the institution. Sometimes those decisions sometimes are unpopular, or maybe it's discontinuing a program, maybe a degree program that's offered at the institution. It just doesn't have enough individuals interested in it that would want that institution to keep offering that degree. And unfortunately, sometimes you have to discontinue certain degrees because it just doesn't have it isn't bringing in enough revenue to justify the number of steps you have to do with accreditation. So sometimes those decisions aren't popular because you are affecting potentially some students. Maybe a student's in a program and they have to finish that program elsewhere because of that. So, but they the key is they have to act what's best for the institution overall. Sometimes, like I said, you want to really benefit the institution in these cases, and sometimes those decisions aren't as popular. Obviously, making sound financial decisions, as I mentioned, to achieve its mission into the future. It's not really looking at the next year or two. You're really looking at the future. You really have to look far into the future and say, how is higher education evolving? What we've seen the last 5 to 10 years is if you don't have an online presence, you're really behind a lot of other institutions. So, you have to make those sound financial decisions that are going to benefit that school in the future. And that's what's really difficult sometimes, is understand what are the trends in higher education? What are we seeing in higher education that's going to benefit our institution well into the future? And that's where a board has to have that responsibility to kind of, look at its master plan, look at, maybe it's acquiring more space, maybe it's reducing their footprint because, more students are taking online classes. So it's really understanding what's the perfect size. A lot of times boards are deciding, or the institution's deciding, what's the perfect size of students. Maybe they can't handle a certain number of students past 1,000, 2,000, whatever that number is. The boards are helping make those decisions with management, of course, on what's the ideal size of the enrollment of that institution. And then obviously it's understanding, it's important board members understand difference in financial reporting as a fiduciary responsibility. I know a lot of times board members come from outside the not-for-profit or government world, and they maybe have that for-profit background and really understand finances, but not necessarily understand the institutions, our higher education, how that works, how a not-for-profit model works, because you have restrictions on a lot of your donations and contributions. In government, the funding comes from various sources, not just tuition. There's other things to balance with that as well. So it's really understanding, board members really understand what the different financial reporting models are, whether it's a not-for-profit school or a government school, is making sure they have that knowledge. And if they don't have that knowledge, get them that knowledge, maybe through some training, some board orientation, things like that could really help a board member understand the financial statements or the financial picture of these institutions. The last bullet point in this slide is one of my favorite. It's really boards have to protect the reputation of an institution, as I mentioned. That kind of falls in some of these other categories, but that reputation is something that takes years to establish. One of my favorite quotes I listed here: it takes 20 years to build a reputation and 5 minutes to ruin it. If you think about that, you'll do things differently. And obviously Warren Buffett, had that statement. It's definitely something that I think holds true with not only in higher education, but really every set of business or every kind of organization. Some examples of fiduciary responsibilities, really evaluating the financial policies of an institution, whether it's investment policies, what does this school wish to invest in? Obviously in the news, people are talking about cryptocurrency. Is that really something that an institution would want to be involved in? Not likely, but it depends on obviously the institution. The next one is gift acceptance procedures. This is important because I've been on boards before where someone wants to make a donation, and in their heart, to them they think it's going to be a great donation, but maybe it doesn't fulfill the mission of the institution, or maybe goes against the mission of the institution. So making sure you have policies that really would be specific. If there's something you'd be able to have to point to, if maybe you unfortunately could be in a position where you would have to reject a gift, and it's not something you'd want to do necessarily, but there could be some circumstances where that gift would go against the mission of the institution. So you want to make sure you have those gift acceptance procedures that are reviewed regularly, because the types of gifts change over a period of time. So same thing with, as I mentioned, with cryptocurrency. Someone may give you cryptocurrency, but are you going to hold it as a long-term asset, or are you just going to immediately kind of cash it in, you would say, and take the funds from the crypto? And then endowment spending, that's obviously important as institutions, as if we're in a investment high, we're in in that bull market, maybe the spending is a certain way, but obviously you go into maybe a bear market, that spending may have to be adjusted based on the market performance. But in the same token, you don't want to obviously lose prospective students, so you may have to adjust some of your spending according to how your endowments are performing, which in good years, it's a little easier to have that discussion. And when years are lean, it's a little more difficult to have that discussion. Tuition rates and discounts are very important as well. Obviously setting management's going to have obviously a big role. The finance department, the whole institution is going to have a big role in that, but the board plays a role as well, is setting that tuition rate, the discount rate, very important because you're competing against 2-year schools, 4-year schools, state universities. If you're a private school or a community college, you're competing against other types of trade schools, maybe, for example. So it's really setting that tuition to make it attractive enough to attract students, new students, but also financial, savvy enough that you're maintaining the finances of the institution properly. That the school is, not necessarily in a position where they're, not be able to show enough revenue to support the various programs. Same thing with auxiliary room and board type rates, setting those rates as well. Student housing is important, obviously, as I mentioned, as schools maybe go away from maybe as much on campus students, that they may have more online courses. So maybe that need for additional space is reduced, but you may have to increase rates. So whatever the mix, trying to find that right mix is difficult. Sometimes I know a lot of institutions over admit people, and then they have to kind of find accommodations for some of those individual students that didn't get into the auxiliary type dorms. And maybe it involves the institution going out and finding apartments and making those institutional apartments that they could lease out to students as well. So those decisions need to be made at the board, based on the enrollment, based on the number of students that wish to obviously live and stay on campus. Other fiduciary responsibilities, obviously there's a lot of non-financial policies that the institution has to make sure they adhere to, and the board has responsibilities of these as well. I mentioned earlier the conflict of interest, making sure that's something that's signed off regularly for the school. The other would be document retention destruction. So a couple of these are one of the carryovers, I guess, from the Sarbanes-Oxley. When that came out a number of years ago, they had conflict of interest, document retention, destruction. The whistleblower, of course, was a big thing. The third one, information security. I know if you participate in this webinar on the first day, you heard some great topics on GLBA, the Graham-Leach-Bliley Act, that requires institutions to be able to protect information security, sensitive information on the students. So that's something that the board should evaluate regularly to be sure that they're compliant with the GLBA, as our presenter talked about on Monday. The fourth one, I guess, is one that I wouldn't be talking about probably 20 years ago, but clearly having a social media policy too is something that could be, something the board should take a look at. What's the policies on social media? Those things could really, I mentioned, talk about reputational risk out of an institution. That's something that definitely could affect their reputational risk depending on how those policies are adhered to. Ethics, whistleblower, of course, is the one that I mentioned earlier with Sarbanes. Ethics is obviously a policy they should look at. Travel and expense reimbursement, that's something that's important. Obviously, people are traveling with institutions. There's conferences, there's tournament things, there's contests, those type things, sports, all that involved in that. What is the policy for that? Purchasing obviously makes sense that they're involved. The board understands what the purchasing requirements are. I mentioned a little bit if you were in the talk yesterday about uniform guidance is going to affect some of the purchasing requirements going forward when uniform guidance takes effect after September 30, 2025. So all those different thresholds for potentially micro purchases or the simplified acquisition, those type things, all those rules that go in effect, the board's going to have to really understand that as well. And then the last one also, if you participated in our higher education seminar webinar yesterday, you learned a lot about the AI, the artificial intelligence too. But now it's important that boards understand this and be able to potentially have to set policies on what they'll allow the institution to use it for. As I know, Ray Bestie, who spoke yesterday, talked a lot about that topic on what the institutions have to do to be able to use it. And it's very important that you have sound policies on how you'll use it and how that's communicated to others. Some other fiduciary responsibilities, obviously, we're going a little bit more into financial, back to the financial a little bit. Obviously, approving annual budgets, operating budgets. The institution has to operate, effectively on an annual basis. So making sure that those operating budgets are approved by the board. capital budgets as you're acquiring new technology. Maybe you're expanding the campus, like as I mentioned, if you need to build new dorms. Obviously, you want to be competitive with other institutions. So maybe you need a new science lab or a new whatever facilities. That kind of falls into the next bullet too, with a master plan for future expansion. What do you need to do on the campus to make it more attractive to students? And that's very important that you have some kind of a plan, and the board's approving that plan to be able to know that you're meeting not only the current needs of the students, but also the future needs as well. Obviously, you're going to receive hopefully monthly and quarterly and annual financial statements that are internally prepared, and you're reacting to those. It's not just you're getting them in the email once a month and the board not really looking at them. I think the board plays a significant role. I know as a board member myself, reviewing those monthly financial statements that are internally presented are very important, because if you wait to the end of the year and just look at the audited financial statements, the year's already passed, right? Then you're more of a reactionary. You're not really in a position as a board member to take any preventive actions to maybe stop some of the issues that are happening. But if you're doing a really good job of reviewing monthly financials, or quarterly at least, but monthly financials, you have a better chance to react to situations. For example, if a program isn't performing well, maybe not waiting till the end of the year to make some decisions. Maybe you have to change the makeup of a particular program. Maybe there's a program that needs additional staffing. Maybe there's a program that maybe has too much staffing, and you could use those resources elsewhere. So the better, more timely information the board has, the better chance of them reacting to situations and making corrections or adjustments on a more timely basis. So accurate internal financial statements is very, very important. Approving new debt or refinancing debt. Obviously, we talked about that master plan or that capital improvement plan. If you have a plan to expand your campus, obviously it may be financed. It'd be great if it's all came from contributions, of course, and that's great as well. If you have a capital plan to raise money, that's great. If not, potentially you have to go out into debt market and either approve new debt. Obviously, if you're a community college or local government, you may have to issue bond to be able to receive that debt. If you're a not-for-profit, you still may be issuing bonds, but you may be going in a private way, or whatever way you decide to obtain that new debt. But the board needs to be obviously involved in that. And maybe it's just refinancing debt. I mean, obviously, maybe now isn't the time, but a couple of years ago, when interest rates were very low, or a number of years ago, that might have been a time to decide whether it needs to be refinanced. Same thing with the bonds as well, bond or regular private debt, those type things. Boards make decisions on what makes sense for that as well. Approving new academic programs, as I mentioned, there could be a need for a new academic program. As who would have thought we'd be talking about a lot of programs that are really into the AI field, or people want to get into the AI field. Well, maybe that's a new program you could incorporate in your IT security. Is a lot of people are interested in that field. So maybe your institution wants to launch that type of a program. Maybe it's an adult learning program at your institution. That's something that people have been displaced by jobs. So a lot of workforce Investment Act or the WIOA programs, those type things, you might want to add to your institution to better reach your community or the potential prospects or students that are applying to your institution. Selecting an audit firm, that's important too. They have responsibility as a board to make sure that they select a firm that's really a firm that is competent, is able to perform well and provide the services that you really request, and having that annual audit conducted. And making sure that you're comfortable with the auditors, you're comfortable with the performance of the audit, and then at the end, having that discussion with the auditors where you're free to ask questions. I think that's the key thing, is making sure as a board you're engaged, that if you have questions or concerns, that's your time to air them, whether it's pre-audit. I think that's the best idea, is actually meeting with the auditors before the audit starts to kind of maybe talk about some of your concerns or concerned areas that maybe the auditors could focus in on those particular areas. But then also at the conclusion of the audit too, to go over the results. I think it's important that you have the ability to meet with your auditors, whether it's just an audit committee that does that, if it's the finance committee, or even the full board, whatever your choice would be. That's something I think is important. Selecting investment advisors, benefit plan advisors, those are important too as well. Making sure you have the best people that are, that your endowment and your investments are performing well, that your benefit, obviously you're attracting employees too, right? And make sure you have good benefit packages, and that your benefit plan administrators are ones that you're comfortable with and are serving the best needs of your institution. Risk management is obviously important too. This is a little bit we also talked about a little bit in the last couple of days, 2 days ago, and on the GLBA, making sure your insurance coverage is adequate with risk management. That's a very important part of the board. Cybersecurity, that was mentioned obviously in our discussions as well. What could happen in a cyber attack? Making sure you have what's your policy on ransomware demands. That was something that was discussed earlier in this webinar as well. Security of private information, that's the GLBA. The next bullet is pretty interesting stat. This is a recent stat too. Of the 5.8 million malware cases, 62% of them were found in the education sector, and that makes sense. Healthcare and education have always been the two areas that are probably the most susceptible to cyber attacks and malware cases, those things. So making sure your cybersecurity is sound, your policies are sound around that, I think is another responsibility, fiduciary responsibility of the board. Understanding the institution's basic financial statements, that's obviously important as well, making sure that you, as I mentioned earlier, a lot of times the board, diverse board comes from different backgrounds, and maybe you have someone that comes from a more of a for-profit background and maybe not understand the government financial model or the not-for-profit model. So that board training, I think orientation is very important, that board members can be able to understand the financial statements, and that lends to a better board because they're going to ask better questions. They're going to ask more meaningful questions or raise concerns if they really understand what they're looking at. Now, I'm not going to do a spoiler alert, so I'm going to let Heather talk more about understanding the Form 990, but that is another tool what the board is responsible for. That is a public record, and Heather's going to talk about that. I don't want to use up her time there, but she'll mention really what the benefits are of that federal Form 990, because that is definitely an item that needs to be considered as well. Board liability. There are consequences, obviously, for boards that fail to meet their responsibilities. Unfortunately, these are things we have to talk about. There's financial penalties that could be imposed on board members if they don't meet their responsibilities. Obviously, the one, so there could be financial penalties that are on the institution and could actually carry on to the board if the board, acted inappropriately. Reputational damage, that's obviously one of those consequences, but there's not really a value you could place on it. You really can't place a dollar value on reputational risk, but it might be the most damaging. It's really difficult to place a value on that because you don't really know, one, how long that reputational risk will be out there, and how do you fix it, and how do you correct that if something has been out there. Obviously, legal action against the institution or board members, as I signed up for boards in my past, we were told, there is a potential, obviously, if there's something was severe enough and the board acted inappropriately, that there could be some individual liability. So that's why we had a board policy as well in case of those situations. So board liability insurance, I probably have it, but if you don't, something to consider, because it does protect the board members individually, because obviously none of the board members want to be part of the potential issues that go on as well. We're going to shift gears now. So we talked a lot about different board responsibilities. I'm going to shift gears quickly to go into the next topic. Is one of the areas that I get asked a lot as a auditor by the board is trying to really understand what that Department of Education comes up with, this thing called a composite score. Really, what is it, and why do we have to adhere to it, or what's it all about? And how do we make it better, I guess, if we don't have a really good score? So that's something I get asked about a lot. So I decided to put this in our presentation. So I'm going to talk about it. It's really a financial health score. It really measures the health of all institutions. Any institution that receives Title IV funds, it gets measured in this health score. Now, I'll give you some background on it. It was developed in 1965. So let's say it's a little bit old, but they haven't found something better since, I guess. So unfortunately, it's one of those things where it's been around a long time. They haven't really modified it too much, but I just want to make sure we talk about that. Um, but what it does, it really measures the financial health of an institution, but it doesn't necessarily obviously indicate the educational quality of an institution. So it's one thing that, it's good that it measures the health, but it doesn't necessarily say that that's a better school. It's really just a uniform measurement. Unfortunately, all the schools are lumped together. So your schools with an enrollment of 500 are lumped in with Arizona State or something that has, several 100,000 when you consider their online program as well. So unfortunately, it doesn't distinguish between small schools, big schools. And so it's one thing that to note here. And for the government schools that are listening maybe in this webinar, I apologize. This isn't something that necessarily affects you currently. Who knows? And maybe there could be something in the future that potentially would affect the government schools. This is really for the, fortunate or unfortunate, I guess, for the not-for-profit schools. The Department of Education compliance requirement is found at CFR or 34 CFR 668172. The Department of Education is really, as I mentioned, it's a composite score. So it makes up combined scores of 3 different items. And that's what's called a composite score for. The scores range, the lowest score you could have is a negative 1.0. So that's the lowest score. That's on the one end. And then on the highest end is a 3.0. So I know educational institutions always want to talk about a 4.0. Unfortunately, for a composite score, it ends at 3.0. So that is the perfect score. So composite score, what is it? It's really a combination of 3 separate ratios. It considers a primary reserve ratio, it considers an equity ratio, and then finally a net income ratio. It's a combination of those 3 ratios. That score gets kind of added together from each of them, and they're combined. Now they're weighted differently, and they are weighted differently for a non-for-profit versus, because the for-profit schools also have a composite score, and theirs is weighted slightly different. The primary reserve and equity, we'll talk about those in a minute, are weighted at 40%, while the net income is weighted at 20%. So that's the big difference between the 3 of them. So what does a primary reserve ratio does? It really measures the viability and liquidity of an institution. It's more short-term focus. So it's going to focus more on the short-term assets and liabilities of the organization versus some of the long-term. So what happens is you kind of subtract out some of the longer-term items. For example, permanently restricted net assets. Oh, it's great to have those net assets, those endowment type things, but the institution can't use them in the short term. That's why they're backed out. So those permanent type things are backed out. Tangible assets obviously is backed out for a reason. You can't do anything with liquidity with an intangible asset. Unsecured related parties, although they may be short term, they're still taken out of the ratio because you can't control, if they're a related party and they're not secured, technically you potentially could not collect on those. The net fixed assets is the big thing. As I mentioned, it's short-term focus, this ratio. So you're taking out of the one part of the equation, your long-term fixed assets, and then finally your right to use assets. That's a newer thing, of course, with the new lease standard. Things that are added to net assets are long-term debt up to net fixed assets. So it's okay to have long-term debt on fixed assets. It's when you have more long-term debt than you have fixed assets where you really get penalized a little bit. And then the right to use asset liabilities and the post-employment liabilities. How do we improve the primary reserve ratio? A couple ways. Obviously, these aren't going to dramatically affect it, but if you're really, really close, maybe you have a 1.49 and you're trying to get to a 1.50, maybe that potentially could help. Is really, obviously, you want to secure those related party transactions. Remember, this is a ratio that's calculated at year end. So what you do at year end doesn't necessarily reflect what you maybe have going on all year. So it's really important at year end to do some of these things. Making sure you're borrowing funds up to net property and equipment. You don't want to borrow more funds than your net, I mentioned, your net fixed assets. Potentially, if you could delay an expenditure into the next year, that's going to add both. It's going to help your short-term liabilities. You're not going to have those debt or that payable out there. And it obviously is going to help with your expenses as well. It's better, obviously. This is one that's a little confusing to some, but it's actually better to have less cash and less short-term liabilities. What's that mean? It seems like it would be counterintuitive. If you have less cash and less liabilities, they should wash, right? But it's not true. It actually, if you have less cash and you're using that cash to pay off a short-term liability, it actually benefits you. It's a strange calculation the way it works, but if you could use some cash to pay down short-term debt at year end, it actually helps your score on the primary reserve score. The equity ratio, now it's the second of the ratios. It has a more capital focus, a more long-term focused, and this ratio really affects the institution's availability to borrow. So it really measures that the ability to borrow, and obviously fixed assets and long-term debt are now included in this ratio because it's more of a long-term focus. The modified net assets, so it's basically a ratio of taking modified net assets divided by modified assets. And the only items that are taken out really, once again, are intangibles because they add no value at all, and unsecured related receivables. So the first ratio is a measure of your liquidity. The second ratio is more of a measure of your long-term focus or your long-term items. And finally, the last, real quick on how to improve that. Once again, if you have those unsecured related parties, pay them off if you can, or secure them if you can. Have them paid off or secure them. Paying down short-term liabilities, once again, that's something that helps. Delaying expenditures helps, and really, helps, with your short-term liabilities and your expenses as well. Okay, the last ratio we're going to talk about is the net income ratio. It really is a measure, obviously, of school's profitability. So that's one of the things we could, obviously it's an obvious thing there is how well is the institution performing from a short-term focus on a net income. What's that ratio of change? It really is a ratio of change in net assets without restrictions. Keep in mind, all these that we talk about are really the unrestricted net assets without restrictions. So your restricted revenue, although it's beneficial to the institution because it's money that's maybe coming in down the road, it doesn't get counted in this calculation at all. So it's one of those things. So, but it doesn't consider restricted revenues. How to improve it? Once again, delaying expenditures. Once again, that's going to help your net income for that year. As I mentioned, it's really a key metric at the end of the year. So delaying those expenditures, that would affect net income. Obviously, the obvious one, next one, increased enrollment is going to benefit everybody, right? It's going to benefit the institution because what it does, it increases revenue, and it doesn't necessarily increase costs on the same basis as the revenue. And of course, any kind of a soliciting unrestricted donations before year end is important. You might do an annual campaign. You might be really stepping up the fundraising near year end, try to capture some of the year end last minute donations. Those type of things would help an institution as well. So really interpreting the score, as I mentioned, the score is going to be between 1.5 and 3.0 is the goal. Scores within that goal is going to be considered, schools are considered fiscally responsible. So if you get at least a 1.5, you passed. 3.0, as I mentioned, the highest, so you're in that range. If you're between 1.0 and 1.4, you're called in the zone. So it's kind of, I call that like probation. You haven't failed, but you need to get out of that zone after 3 years. You can only be in there for 3 years. It's kind of like, I call it the penalty box maybe in hockey analogy. So you want to come out of the penalty box at least at that third year mark. So that's one of the things you want to obviously achieve. If you're below 1.0, you're considered not fiscally responsible, and potentially you're going to probably one of two things. You're going to have to obtain a letter of credit, and that letter of credit could be a percentage of your prior year student financial aid. So if you had, $2 million of financial aid dispersed last year, potentially, it could range from 10% up to 50%. Usually I've seen maybe in a high end 50%, usually in that 10% range. Potentially that amount, 10%, $2,200,000, you might have to obtain a letter of credit up to $200,000, maybe up to $1 million, depends on where the department's going to come back at. So those are some of the, I guess, the consequences of not passing the composite score is potentially having to obtain that letter of credit. And then finally, final thoughts on the score. As I mentioned, you want to improve the score, but you also want to be aware that you could have debt covenants that have to be considered as well. So it's not necessarily just trying to get the best composite score, maybe it could affect your debt covenant. So making sure you've considered those as well. If you're having an unusually strong year, maybe you could consider writing off some additional receivables this year because you already have a really good score, and maybe that'll set you up in the future better. Obviously, anything you could do, ratios, improving your balance sheet year end. As I mentioned, it's a year end exercise, so making sure you're aware at year end what you could potentially do. My best advice on a composite score too, and we have institutions we work with, they actually calculate it quarterly, and it's not doesn't go out anywhere, doesn't get submitted anywhere. The auditors don't even look at it necessarily, but it's something they monitor themselves. They know if they have to be reactionary or not based on the score that they're seeing. And keep in mind the Department of Education could calculate the score a little bit differently. It depends what they want to include or exclude in some things. Usually it's pretty accurate. But really the whole idea of the composite score too is really for schools to develop a long-term approach. Schools are encouraged to invest in capital and technology and really improve the students' experience on campus. That's really the approach that the composite score is trying to achieve, making sure that the school is liquid enough to be able to meet the current needs of the students and the institution itself. Okay, well, I'm going to introduce Heather Boniface. I'll let her introduce herself too, give her a little bit of her background. She's going to take us through the rest of our webinar today and talk about the Federal Form 990, which is another important tool that boards have to consider as they monitor the institution.
Thanks, Ray. So as was mentioned at the beginning of the presentation, I'm a tax senior manager here at Sikich, and I work primarily in the exempt organization area, though I do still have some for-profit experience as well. And today I'm going to get into why it's important for the board to review the 990 and some of those specific details of the 990. One reason it's important is because there's a question on the 990 that asks if the board was given a copy of the return ahead of filing. So it's right there on the 990 saying that you were given that opportunity. And then something else I wanted to point out is that the Form 990 is an information return. So this just means that it contains a lot more descriptions of the organization's activities rather than just financial data. So it's really emphasizing that information about your organization. And the biggest reason it's important for you to review is that the 990 is public information. So donors or potential students can have access and review this document to get to know your organization a little bit better. And that's even if you don't post this document on your website. There's other third-party websites like GuideStar that'll publish this, and now even the IRS has a database showing this 990 to the public. And so this is just really a place that you can boast about your organization's purpose and your accomplishments because it is viewed by the general public. So next, we'll jump to the next slide and get into a few of the key parts of the 990. So that first part is part 3, and this is what shows your program service accomplishments. So line 1, the very top of this part, describes the institution's mission. So this is what Ray got into. So it's really important to make sure that thoroughly explains your organization's values, but it also can be rather simple. And then down in line 4, it'll describe all of your institution's program service accomplishments. So if you want to go to the next slide, this is what it looks like on the 990. So it's maybe a little bit hard to see on this small slide, but the top section is your mission. So as Ray had mentioned, sometimes it's good to keep that fairly simplified so that it all shows right here in the number of characters available. It can spill onto another schedule, Schedule O, but again, it's most important to have your best details on that fit in this section. And then down at that bottom section, there's a large description for each of your top 3 program service accomplishments. Again, this can spill onto another schedule, but it's always good to keep this format in mind so that all of your most important details show up here. So the next slide, we'll get into a few other parts. So 990 Part 4 is a summary of the required schedules included within the Form 990. So this is good to glance over so that you're aware of what's going to be attached to the rest of the 990 and kind of aware of what was attached last year. Part 5 of the 990 is all about IRS filings and tax compliance. So this lists the organization's number of W-2s and 1099s filed and just has some other questions in there to make sure you're correctly handling filings with the IRS. Now, part 6 of the 990 is all about the governing body and policy disclosures. So this is the most important part to pay attention to. And on the next slide, we'll get into some more details of this part. So part 6, section A, is all about the governing body and management. So this has questions like providing the number of voting board members. And it also has a line for the number of independent voting board members. So those that are not compensated and don't have any other reason to make them not independent voting board members. And there's also a question there about board meetings and if you're taking minutes at those meetings. Section B gets into a little bit more of the details on your policies. So one of the questions in there is what I mentioned at the beginning. Has the organization provided copies of the 990 to all board members before filing? So the goal here is to have that be yes, so that all of you are reviewing these different policies and parts of the 990 before it's even filed to make sure everything's accurate. As Ray mentioned too, this also has the question about having a written conflict of interest policy, because that's important to making sure the governance is correct and you're following the correct procedures. And this part of this question is also if it's reviewed annually by the board. Because as Ray said, there's no problems with conflicts. There just has to be policies in place to make sure board members aren't part of those votes if they do have a conflict of interest. So that's all spelled out here in the 992 just to make sure all the bases are covered. And then another question in this part is, did the organization have a whistleblower policy? So if we want to go to the next slide, another big question on this part is, did the process for determining compensation include a review, approval by independent persons, so not the board members who are compensated, comparability data, so another organization's 990, and contemporaneous substantiation and deliberation of that decision for that amount of compensation. So basically, it wants to make sure the compensation for the executive director and the other top officials is supported with other data and that it's in the board minutes and it was voted on the decision to make that amount of compensation. And another question here is, did the organization invest in, contribute assets to, or participate in a joint venture with a taxable entity? Again, there's no problem with this arrangement. It's just that it has to be disclosed. So this is becoming more and more common, and it's just something good to make sure you have information on that if it's a venture you're going to join. So we'll go into the next slide. And I just briefly here have what this looks like in the 990. So the top section is all about the governing body and management. So you'll see that line 1 in A and 1B is where you show the number of voting board members, how many of those are independent. There's also a question here asking if any board members are related, so either with a business relationship or a family relationship. Again, it's just trying to get into that independence and make sure all the decisions of the board are solid. And then section B at the bottom is all about those policies. And you'll see, it's hard to see in this detail, but when you do pull up this part of the 990, a lot of them request a statement to be included describing the policy and how it's monitored in some cases. And that all spills onto Schedule O. So that's that same schedule where your additional mission statement would go, any other program descriptions. So that's somewhere to go just to make sure those policies are really accurate for what you're doing as a board member. So we can go into the next slide. And this is part 7 of the 990, which is listing the board members, officers, and most importantly, their compensation. So this is always a highly viewed part of the 990, so it's good for the board to pay attention to too, to make sure it's accurate since the entire public has access to this. And right here at the top of the schedule, it says exactly who should be listed. So there's details there for the viewers of the 990 and the board if you're ever questioning that. And on the next slide, we'll get into some of the details of what needs to be reported. So the first is who should be reported here. It's all current trustees, directors, officers, or key employees, and then the top 5 highest compensated employees. But we'll get into the details of what each of those means a little bit later. And then what should be reported as far as compensation is compensation on a calendar year basis off their actual tax legal document. So that'll be the amount off of a W-2 or a 1099 that was issued within the fiscal year if you're a fiscal year filer. So there's an example here that a 5/31/25 filer would use the 12/31/2024 W-2 information, and that's because it falls within the fiscal year. And one other note I want to make here is that the statement of functional expense also shows compensation for the officers, and that compensation is based on the fiscal year if you're a fiscal year filer. So there may be two different compensation numbers reported on the 990, and that's just good to know because there could be a discrepancy. So the next, we'll get into a few of the more detailed descriptions. So an officer, and this is straight from the 990 instructions, is a person elected or appointed to manage the organization's daily operations at any time during the tax year. And that tax year is the fiscal year. So even though the compensation is calendar year, the officers listed is for the fiscal year covered by the 990. And a lot of times these officers will be listed in the bylaws or other documents from the governing body. So these are roles like the president, secretary, treasurer. And if there's a smaller organization, it may not always have each of these positions, but no matter what, at the very least, we always have to list the top management official and the top financial official. So if we go to the next slide, we can get into those definitions a little bit deeper. So the top management official is the person who has the ultimate responsibility for implementing the decisions of the organization's governing body or for supervising management, administration, or operations of the organization. So this might be the president, the CEO, or an executive director. But regardless, the person with these powers has to be listed as an officer. And the other position that must be listed is the top financial official. So this is the person who has the ultimate responsibility for managing the organization's finances. And the note here at the bottom is that this could in some cases be the same person. So an executive director very well may have the powers of the top management official and the top financial official. But this is just something to consider from the 990 instructions. So we can go into the next slide and we'll get into the definition of a director or a trustee. So this is a member of the organization's governing body at any time during the tax year, so that fiscal year, but only if the member has actual true voting rights on the board. So a member of an advisory board that doesn't exercise governance isn't considered a director for purposes of Part 7 of the 990. And another key at the bottom is just emphasizing that it's a voting member. A non-voting member, an honorary member, would not be listed on Part 7. So next, I'll go to the definition of a key employee. So this is something very specific from the 990 instructions with a three-part test. So the first part of this test is, does the employee make over $150,000? But even if they do, they may still not be a key employee. Not every organization will have key employees. The second part of this test is the responsibility test, meaning does this employee have shared responsibilities over the entire organization or at least 10% of the organization's activities? So if somebody runs all of the programs or oversees all the programs for an organization, they probably do pass that second part of this test. The last part of the test is that they must be one of the 20 highest compensated employees. So even if they're over 150,000, but they're not in that top 20, they still don't qualify for this category. So the next and last category that's on Part 7 is your highest compensated employees, but this also has a couple different pillars within it. So it's the 5 highest compensated employees that make over $100,000 for the calendar year. And this is the top 5 after all the other categories listed. So this is after officers, directors, trustees, and key employees. So even if you had 5 officers compensated over $100,000, you still then need to go into the next 5 highest compensated. So if you have employees over 100,000, and there's at least 5 of them, there should be 5 listed. We'll go into the next slide. And this defines what specifically should be reported. So reportable compensation is that taxable compensation to an employee or officer, and that comes from their specific W-2, Box 1, or Box 5, whichever is higher for the year. And again, it's that calendar year W-2 that falls within the fiscal year. Or 1099 NEC compensation. And then other types of compensation are also reported, and some of those common ones are employer paid health benefits or employer paid retirement match. And so the next slides are specific to the 990 instructions. So within those, there's these really big charts listing almost every type of compensation you could think of on here, and it tells you where to report those amounts on the 990. So if you ever have a question, this is just a good resource and reference to go to. So if we'll go to the next slide, it's a second page of all that type of compensation. So it's just a really long list if you ever need access to that. And we can go to the next. So this next slide goes into the first schedule, so the first attachment behind the Form 990. And this schedule is responsible for explaining the public charity status, which comes from the original IRS determination once you became an exempt organization. And it also contains a public support test, just sort of showing that you are still year over year supported by the public in an organization that's needed. So we can go to the next slide. This is the very first part of Schedule A. I just quickly wanted to point out here that lines 5, 7, and 12 are very common college foundation ways to be exempt. So it's just something to consider when you're reviewing another foundation's 990 that there are different types. So depending on the type that you are, there might be different reporting on the 990. Go to the next slide. And then just a tiny bit about the public support test. It's that you must have 33.33% of your revenues from the general public. So this is tested on the Schedule A, and it's just trying to make sure that you're getting more money from government entities, public charities, or smaller donations from the general public. This isn't something that needs to be monitored closely all the time, but it is something to glance at if you're ever about to accept a very, very large donation from one individual or an estate. It's just a number to glance at. So we can go to the next slide. And this is what that public support test looks like on Schedule A. So it's a 5-year rolling average test. So it is just something I want to point out that if you ever do have one large donation, it will remain on this schedule for 5 years. So if that is something that's coming up, it might be good just to put out a different campaign to try to get some smaller contributions in that same year to keep your ratio correct to pass this test. So we can go into the next slide. This is one more schedule that is attached to the 990 that you may want to pay close attention to. And this is listing contributors that have donated more than $5,000. So this should be any amount of contribution that's included in revenue. So that's government grants, fundraising contributions. And the biggest thing I want to point out here is that this schedule should match how your revenue is reported on the 990. So accrual basis filers should be providing information that includes pledges as they're included in the books rather than when payments are made. And then another item to point out here is this schedule, since it has those donor details, is not open to public inspection. So even if you have a donor that wanted to remain anonymous, but the organization has that detail, it does have to be included on this schedule, but it'll only be reviewed by the board, the tax preparer, and the IRS. It will not go beyond that. And then a little note at the bottom is that in-kind services and in-kind rents are excluded from reporting and revenue. So it's just something to keep in mind if you do have a high in-service rent from a college, it won't be reported anywhere on the 990 as revenue. So you can go to the next slide. We'll quickly get into this just because I know we're about done with time here, but a hot topic is always unrelated business income. And one big misconception here is that UBI is a bad thing and it should be avoided. That's by no means true. if there isn't UBI, unrelated business income opportunity, it might still be a great generation of funds for the organization that they can use to support their mission. It really is just important to know that it should be reported and the tax applicable has to be paid. So we can get quickly into the next slide. And this is the three-part unrelated business income test that should be referenced and gone to whenever you're considering a new revenue stream. So that revenue has to make sure to be unrelated, so not supporting the mission, but this does have a little wiggle room because in education it could have students involved or any sort of other educational purpose and not be unrelated. Then the next pillar of this is it must be a trade or business. So there has to be a business plan in place with a profit motive. So really the organization has to be competing with for-profit businesses and making money on it. And the third pillar that it must be to be UBI is regularly carried on. Again, there's a little bit of gray area here, and so something that's seasonal might be regularly carried on, but if you have it twice a year, it still may not be. And a caveat is that this does not include fundraising events income because that's not regularly carried on. It's just a one-time thing. You can go to the next slide. And this is just a brief detail on what is not UBI. So you're allowed to have interest, dividends, passive royalties, and then another exception is convenience of members, students, or employees. So those fitness centers and dining halls are okay. Then we can go to the last slide. And this is just informational. I'll skip reading all this, just sponsorship versus advertising, which is UBI, just good reference there.
Thank you all. Thank you to our presenters for the day for all of the great information that they have shared. Thanks to Carrie, Ray, and Heather for their contributions to the forum today.